Today, we're going to talk about how to identify winning stock patterns. And we're going to talk about two main categories of stock patterns, and that is reversal patterns. In other words, how to identify key inflection points so that you'll know when it's time to buy or sell out of a position. And we'll also talk about what's called continuation patterns. And these are patterns that tell you that despite the brief pause that refreshes on the market, that trend that you've been following is likely to continue, be it up or down. At the end of the video, I'm going to talk about two key books that I think every viewer of this video who's interested in market patterns should read. For those of you who are just coming across this video, this is the second part of a series that I have been putting together on technical analysis basics. So we're going to cover the A to Z's on technical analysis, but we're not going to go down the rabbit hole too far. For those of you who want greater detail, including a full trading program, I would encourage you to take a look at my online trading course, which is seen on the website at valuetrend.ca. Well, as promised, we're going to start off with reversal patterns. And these are the sexy patterns because you get to find out if a market's making a bottom or a top, at least potentially making those patterns. So let's take a look at a few of the most popular patterns, at least most recognizable patterns. And I always like to condense my work down to what's the easiest to work with, because there's many, many patterns, and we'll talk about some books that discuss those patterns at the end of this video. But I really want to get you understanding the most important patterns, the easiest to recognize, because really what I'm all about is pragmatism. And I really want you to understand how to use this stuff in a very pragmatic way. So let's take a look at some more popular patterns. One of the easiest to identify is called the double top or double bottom. And like the name implies, as seen on this chart, you tend to get two troughs if it's a bottom or two peaks if it's a top, that are roughly at the same height. There's some sort of a neckline, we call it, where the market has made a low, so it's gone up, it's made a low, it's rallied to the same point, and then when that neckline is broken, we have, in this case, a new downtrend, or if it's a double bottom, a trough, a peak, another trough at the same level, and then it breaks that last peak and it moves up, we have the sign of an uptrend. So that's called a double top or double bottom. Same with head and shoulders. In fact, if you were to ask me what the most popular pattern that most investors learn when they're first studying technical analysis, it's this, the head and shoulders top or the head and shoulders bottom. And really, it's just like the name implies. It's got a couple of shoulders on the side and a head that's taller in this case with a neckline. So the neckline is where, if you remember the concept of support and resistance, this is, in this case, the neckline on a top is at the support level. When support is broken and we take out that last low, which was at the neckline, we have evidence that that was a head and shoulders top and we're about to enter into a new downtrend. The reverse is true with the head and shoulders bottom. You've got the low on each side and a higher peak in the middle with a neckline of resistance that is consistent, it's taken out, and we move into a new uptrend. So this is actually a very recognizable pattern. When you start looking at stock charts, you will see head and shoulders bottoms fairly frequently at key inflection points. So it's one you should understand. I would emphasize at this point, by the way, that understanding or remembering the names of each specific pattern is not what counts here. What's most important to understand is that the tune has changed and the market has taken out some prior lows or prior highs and is moving in a new direction. I don't care if you call it the pink zebra formation. It really doesn't matter. What matters is peaks and troughs, and we're starting to see a breakout in one direction or another. So final pattern is one that I find very hard to recognize, but I'm going to show it to you anyways because it's one that's kind of popular. I actually don't rely on this pattern very often. I'm going to show it to you anyways. It's called a wedge. Now we're going to get into a similar formation to this in a minute when we look at continuation patterns. And that's why I find that the wedges are not super predictive, because they look in some ways like a continuation pattern. Nevertheless, this is a rising wedge where you're getting higher highs and higher lows. And instead of it looking like a symmetrical pattern, like a symmetrical triangle, the wedge looks like a doorstop, just like a wedge that would go underneath your door if you want to keep your door open. You can see why I find it a little hard to recognize at times. And then if you do recognize the wedge, you'll see that the market often moves down if it's an up wedge. Same thing in a falling wedge. You're getting distinctively falling peaks and troughs with more of a linear pattern on the bottom. And that, again, looks like a door wedge. And if it breaks out to the upside, you have evidence of a new uptrend. Again, I don't use these patterns a lot because, quite frankly, I find them a little hard to identify, but some of you may be able to identify them easier than I can. And that's what the point of this exercise is that we're not all the same. We don't all see things the same way. So you might be able to identify wedges and profit by trading off of them effectively. All right, now we're going to talk about continuation patterns. Now, continuation patterns continue to fall back on the rules that I taught you in my video on charting basics. And that is where you're no longer seeing higher highs and higher lows. So continuation patterns can be sort of a rectangle, where we call this a bull flag, that breaks out to the upside. The only way we know this is a bull flag is when we're already in an uptrend, it consolidates, and then instead of breaking down, it moves into a new uptrend. You will see bull flags and bear flags in a bear trend all the time. These are just basically short periods of consolidation that move up and down for a while and then continue on their merry way down or up, whatever the major trend is. Now, the other thing I like looking at is triangles. Now, this is called a pennant. When it's on a very short-term basis, we will see a bearish pennant or a bullish pennant. That is, the market's been moving up. It forms a triangular pattern where the volatility is bigger on the left side of the chart, and as time moves forward, the volatility gets lower and lower. The market does not like low volatility. It likes to be moving in one direction or another. So when it breaks out after that eventual crunch, whether it breaks out to the downside or breaks out to the upside, after that period of crunch, when the pattern is consolidating, you now have some kind of explosive pent-up energy ready to go on the breakout. So that's why pennants, whether they're bullish or bearish, tend to be good signs, particularly when they move in the direction that you're hoping. Speaking of triangles, triangles are one of my favorite ways of looking at consolidation patterns because they're bigger than pennants. They can take place over many, many weeks or even months, and they tend to again emphasize that the market was very volatile in the past, but that volatility is getting smaller and smaller. The less volatility means that investors are coming to some sort of a conclusion as to what the price should be. Well, that's not going to last forever because eventually the energy returns in positive or negative news and the market moves up or down aggressively. So let's take a look. I'm going to start with the one at the bottom here. It's called the symmetrical triangle. It's the easiest to find. Basically, you have very wide swings that get continuously more and more narrow, but they move symmetrically. So this peak and this peak are successively lower. Same thing here, and then there's a breakout. Now the breakout could happen to the upside. That means there could be an explosive move to the upside, but the breakout could also move to the downside, and that can indicate a lot more downside to come. They're very telling. I find them actually very, very predictive when we find symmetrical triangles and right angle triangles as well. So let's talk about right angle triangles. This one is usually a bearish breakdown. Why? Because the peaks have been getting successively lower even though the troughs were staying flat. Typically, these do break down on the downside. It's fairly obvious why the peaks were getting lower. Still, the volatility, just like with the symmetrical triangle, has grown narrower and narrower as time went on. That's important to understand because, again, that volatility will not stay low forever. Nothing stays the same, as they say. Ascending triangle, it's the opposite. It's the peaks remain flat, but the troughs are getting higher as the volatility shrinks, and that usually results in a positive breakout. Now, again, from experience of 35 years of trading stocks, I can tell you that this is the case. Typically, ascending triangles do break out to the upside, and descending triangles typically do break to the downside. Does not mean that they always do, but typically that is the case. So that's why I wanted to show you the triangles. I find them pretty accurate. Well, this is my favorite part of this video because I'm going to show you the chart of natural gas. And I personally have traded through my many years of investing natural gas. It's just an excellent chart to trade. It's definitely not a buy and hold type of security. But let's take a look at natural gas going back to about 2009. And you can see I've marked them on the chart here, but this is a head and shoulders bottom. Note the two shoulders and the head and the neckline and the breakout, and off we went. All right. Another good example, another head and shoulders here. You can see the shoulder, shoulder, and head. But here's a triangle. You can see that the peaks were getting lower, but the troughs were rising. That's a symmetrical triangle. The market did not like that lack of volatility as the triangle consolidated, and sure enough, it broke down some more. Now, this is, do you remember, one of those right angle triangles? This is a descending triangle. The peaks got lower and the troughs remained the same. Well, what happened is we did get a brief breakout, but then boom, all the way down. This is a double bottom. Look at the two peaks, or I should say, look at the two troughs, and here's our neckline. So same thing, a double bottom, a neckline, a breakout, and off we went, and a triangle to show the continuation pattern. Symmetrical in this case, peaks were getting lower, troughs were getting higher, a breakout, and off we went. This could be called a pink polka dot bear pattern. I really don't care. What I'm interested in here is the market is no longer making higher highs and higher lows, and it's breaking down. In this case, there's the neckline. It broke down. And once again, back in 2023-24, we saw shoulder, head, shoulder. This was very precise, a very easy to identify head and shoulders bottom, perfect neckline, and the beginning of a breakout as I speak. I hope that helped you understand how chart patterns work, and I'll just bring your attention to a couple of books that I strongly recommend. The first book I want you to take a look at is my own book, Sideways. Now, I'm not trying to plug my own book here. What I'm trying to do is show you a book that gives you the basics. I wrote this book for retail investors, and everything in this book is easy to understand for retail investors. So I've listed a number of the basic trading patterns, some of the ones we were discussing here, as well as a few others, and I think you'll get a lot out of it. The next book I want to talk about is the granddaddy of stock pattern analysis. This book is thick, as you can see, and it's got reams and reams of stock patterns in it. It's definitely not a pattern book for those who do not like to go deep down the rabbit hole of technical analysis, but if you like a lot of detail and a lot of patterns and all the statistics that go with it, the writer, Thomas Bilowski, I hope I'm saying his name right, studied patterns going back many years, and he found the accuracy of all these different patterns on a percentage basis, statistical basis. It's a fascinating book. It's a real reference guide. It's not something you're going to sit down and read cover to cover, but I think it's a valuable asset if you do like stock pattern analysis. Well, thanks for watching today's video. Again, I recommend that if you are interested in a complete technical analysis strategy, including money management, asset allocation strategies, hedging programs, that kind of thing. I discuss all of that on my online trading course. It's available at valuetrend.ca, and it expands on everything we talked about here in greater detail. Thanks for watching, and be sure to catch me in my next videos.